Good afternoon, everyone. It's John Pocoroba with a general market update. It's just after the market close on June 10th, 2022. So as a reminder, I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith, and the presentation today is made by Rain King LLC. Before we get into the market, just wanted to let the people know again about the Blue Sky event that we hold every year. You can pause your video player, a lot of great speakers. October 15th is the date. It's an all-day event. It'll be virtual by Zoom, so everyone can participate if they'd like. So look for registration to start after September 1st. So the big picture context we'll talk about, some market internals, some psychology of bear markets, and some names to watch. So back to the big picture, my starting slide. Again, looking at the big picture, the NASDAQ could still come down into this, these trend lines, long-term support areas that I've drawn. The upper trend line is around the 11,000 area, and I've shown a zone that could also hit the lower trend line, which is approximately the 10,000 area. And I've been showing these for many, many months, where we could come down to those zones and still be in a very super cycle bull market overall. Last time we spoke 2 weeks ago, I shared this chart, which was the NASDAQ, and we talked about, in my opinion, we've had two legs down. The second leg was faster decline than the first one. And I had really noted that we should watch this rally attempt pretty closely because we might move higher, but also it could reverse and have another sharp leg move lower. And I tweeted out some target ranges that the indexes could move to if we turn lower. So this is the indices as of today after the close. The NASDAQ on the left, I had noted that there was a lot of thick overhead supply that we were going to have to get through. But the follow-through day didn't go very far. We had a distribution day on day 2, and we've had 2 distribution days in the NASDAQ in the past 3. So this rally did not even make it to the 50-day moving average based on some news today with the consumer price index. So on the right, we have the S&P 500, and we actually had back-to-back distribution days. And we'll talk about the consumer price index certainly showed inflation was strong, and that probably the implication is the Fed is going to have to be even more aggressive to knock inflation back. So before we leave the indexes, I wanted to just talk about a few internals. This chart I put up a couple days ago, and it was the new highs, net new highs, and this happens to be on the NYSE. And what I noted on this was, at the time, on the 7th of June, the breadth was showing some net highs in the rally, which is a good sign. But we also had very similar looking net new highs when we had this rally back in March. The thing that was noticeable to me was this rally, look at the slope of the rally, and look at the slope of the rally that we've just started the last few weeks. It's much more flat. While this was a decent sign, yesterday we took a sharp turn for the worst. There were approximately 100 net new lows on the NYSE, and I haven't seen today's numbers, but I'm sure they're not very good. Now on the NASDAQ, here are the we had net new lows as we rallied in March. Now this rally attempt, you'll notice it was flatter, and the net new lows are actually larger than the rally we had in March. So the rally looked weak to begin with, and it's obviously turned south. 2 weeks ago, I raised my concern about the top chart, which is the put-call ratio for all equities, and the VIX. And my summary 2 weeks ago was I wasn't seeing the kind of fear and panic that we usually see at bottoms. And I had mentioned we might get a retest of the lows, maybe we'll undercut. And most importantly, growth stocks, which usually lead new bull markets, were not really set up at all. So it didn't seem like we had reached a bottom yet. So let's talk about bear markets a little bit. I shared this last time. There's a psychology of how bear markets work. The first leg down is the initial decline. It can be gradual. And as investors look at it initially as a correction and a buy the dip mentality. The second leg down, after that first rally fails, the decline accelerates quickly and people start to really perk up and say, I have real concern now. And they're probably stuck holding some losses in stocks, and their psychology is, I'm hoping for a rally so I can get out. And the third leg is really important, or even a fourth leg, where the next rally would fail and everybody sees the decline. It becomes really, really obvious and people really head for the exits. People start to panic. They throw in the towel. They start selling everything. And you get really those capitulation bottoms. So today, the news driven by the CPI reported inflation was, I think, at 8.6%. We also have a Fed meeting next Wednesday, so there's going to be some news next Wednesday in interpreting the Fed. But certainly, this looks like the Fed is going to have to be more aggressive. Inflation, as I showed on previous videos, can be very, very sticky and very hard to defeat, as was shown throughout the 1970s. Also, the 10-year note, the yield on the 10-year note has been rising the past 2 weeks. And, is this really the market signaling to us that it's not done discounting the impact of a possible recession and even higher rates? And the implication being with the CPI report that maybe the Fed has to get even more aggressive about rate hikes. Maybe there's going to be 3/4 of a point, maybe a full point. I think these things are probably be discussed by the Fed because these little rate hikes starting from a baseline of 0 is just not going to knock inflation back. So if the Fed gets very aggressive, it could affect all the different sectors, including the energy sector. So I've shown this slide before, but it's a good refresher. Bear markets, and my definition using the S&P data is, after you have new lows after two failed follow-through days within 3 months, means we've entered a bear. The current S&P low is a 21% decline in approximately 158 calendar days. Now, the definitions that I use, a 25% decline in the S&P would be what I would call a major bear market. Now, the S&P would have to get down to the 3614 area, so there would be needed to be another 7.3% decline to get to this trigger of a 25% decline. If we hit that, some of the statistics I keep, there's been really 6 major bear markets since 1971. The average loss is 39.8, and the average to the eventual low of the bear market took 546 days. So the important thing to note is bear markets are measured in months and years, not necessarily days and weeks. And the average, and I stress this is the average, there's 7 failed follow-through days in these 6 major bear markets that I mentioned. We currently had 3 failed follow-through days in this particular market. So I wanted to show you a couple of examples. This is the NASDAQ bear market from 2000 to 2003. You'll notice that there were actually 5 legs down. We had a first leg down, and then you'll notice a very, very sharp rally of 41%, a second leg down, a 30% rally, a 44% third leg, then a rally, a 40% leg down, and a fourth leg, and then there was a sharp 51% rally in 16 weeks, and then the 5th leg down was another 47%. This took 3 years to unwind the dot-com bubble, and the index lost an amazing 78% of its value. Bear markets can grind, serious bear markets can grind for years to the eventual low. This is the S&P during the same period, 2000 to 2003. And I noted that there's 7 failed follow-through days on this particular bear market. I've noted the follow through days in the S&P 1, 2, 3, 4, 5, 6, 7. And it wasn't until the 8th follow through day that the new bull market had gotten underway. So, and what do I mean by failed follow through days? It's considered failed if it undercuts the rally attempt low within 3 months of the follow through day. So that's the definition that I believe IBD uses and I use as well. And as a reference point, you know, a high inflationary period, this 1973 to 74 bear market had 9 failed follow-through days over a 2-year period. It was a very, very bad bear market. So let's look at bottoms and talk about, you know, things we're looking for in new leadership. I showed these 2 weeks ago, but I want to just refresh everyone. You know, the market looks like it's going to retest its lows or maybe undercut. We want to be looking for new leadership, and the early signs of leadership could be looking at stocks that have actually had a prior uptrend, and as the index makes a low, these particular stocks did not make a new low. We start to see a divergence. So you should study these further. I'm not going to go over them in great detail. You can go back to the video 2 weeks ago where I speak a little more about them. But again, this is the 1982 bottom, Walmart, prior uptrends, the indexes make lows, this ability to coordinate what's going on with the indexes making lows and what these potential growth stock leading stocks could do is really a key chart reading skill, and to line these things up to understand where there is relative strength at the bottom of the market. So the important point was, you know, new bull markets are going to be led by new growth names at some point. They're usually innovative companies you might not have heard of that have come public probably in the last 2, 3, 4 years, and they will start showing strong earnings and sales. But the key characteristics of these ones we've studied from history are there's a prior uptrend. There's a prior uptrend off the lows. You don't have to try and buy the low of 20 to 25% uptrend. And then you get a proper base to form showing accumulation. And the signs of accumulation could be blue spikes on above average volume, tight weeks in the base, gap ups in the base, multiple up weeks in a row in the base, and tighter ranges and lower volatility in the base. Those are all signs that institutions are acquiring stock. So we want to look for that relative strength, looking for those divergences with the indexes. And again, avoid bottom fishing. The old leaders, they seldom come back to recover. So there are a few names that I think on a very bad day today, there still are names that I think should be on your watch list to watch. We want to watch them and how they react to this retest by the indexes. So again, we're looking for divergence where the index might make a new low, but the names that were on our watch list start to show relative strength. So here's a few names, and I'll just sharing really quickly why I have them on my watch list. WWE, the breakout is actually still holding, and the stock is above the 50-day moving average. Halo, still above the 50-day moving average. Shockwave, it's above the 50-day moving average, and there's been very big blue spikes actually for the last couple of months. And what was particularly noteworthy today is the stock was actually up on a bad down day for the indexes. Celsius, still above the 50-day after having an uptrend, a prior run-up. So we want to see how it reacts as the indexes make a low. Some others, this is NetScout, above the 50-day, trying to hold the breakout level. DLO, pulled into the 20-day, it's still above the 50-day. Enphase, pulling back to its breakout pivot point. Let's see if it can hold. It's above the 20-day. OLPX had a prior run-up, a nice run-up, and it's still holding the 50-day, so it's worth watching. And On Semiconductor is holding the 20-day and 50-day. So there's a few ideas of things you might be wanting to watch, particularly as we retest the lows and if we undercut the lows. What's noteworthy is if these particular stocks start to make new lows themselves, then what do? Well, we have to start the whole process over again. We have to look for the next rally attempt, and we want to see stocks, growth stocks, that create a prior uptrend to get above their 50-day moving averages and hopefully their 20-day moving averages. And then we want to see a base form. So if this market really starts its third leg down and it's a sharp decline, it's possible that all these stocks on the watch list undercut, and we would start the whole process over looking for uptrends. The reason they're on my watch list is they are above the 50-day in most cases, and they've all formed a prior uptrend. So we want to see if they form bases or not. So the Boston meetup, I wanted to remind people we're having our next meeting on June 23rd, and Steve Sweats, who is a longtime CanSlim investor, will be joining us, and he'll be speaking about shakeout entries done the CanSlim way. It's an excellent presentation. Encourage you to join. The way to join is go to meetup.com and search the Boston IBD meetup. And just a reminder, you must register via the Zoom link and provide your email to attend this particular meetup and all meetups in the future. And you will receive the link to the event and the recording post-event. So that's just a reminder there. So that's all the time we have for now. You can join me on Twitter. I try to post maybe once a day. Hopefully you'll subscribe to my YouTube channel and retweet if you think the video is helpful. We'll see you all in 2 weeks at the Boston meetup, and I'll be giving my next general market update. Take care.